It gives me great pleasure to bring on board Neelkanth Mishra of Credit Suisse. Mr. Mishra, good morning. Thank you for changing us. Well, what an initial reaction to the budget from the stock markets. Is it justified? Do you think this budget in itself is nothing short of path-breaking?
No, I think the market reaction was partly relief that tax rates had not gone up and that the government was sort of pushing for growth, and partly I think the realization that after a long time the government is really gunning for growth, meaning that when they launched the production-linked incentive schemes in November last year, it was very clear that the government's policy towards the economy, that it was important to trigger growth, putting money behind it. That was reaffirmed in the budget yesterday, where the government not only has announced an expenditure to GDP ratio, which is the highest in 30 years, but also that it is also banking on supporting the consumption and investment sentiment, realizing fully well that it cannot do all the spending that needs to be done. And that's why, and realizing that, say a COVID cess or a surcharge would have sort of delivered maybe 20,000 crores. Instead, in an environment where the whole world is used to higher fiscal deficits, let's go ahead and create some fiscal space for that. So all of those are, I think, very positive. The medium-term projections for, even the fiscal deficits, the government will have much more room. As you know, large organizations cannot change course very quickly. For the government to even, design schemes which solve some of the problems discovered during the pandemic, I think we will need to see a lot more work. And so that will happen over the next couple of years. And that's all of that, I think, the market tried to price in yesterday.
Do you think the orientation of the market, Mr. Mishra, now could change? Because if so much of government spending is coming, it's going to be coming in the infrastructure space, which means we could really look at a complete wave of industrials, corporate banks, the point you've been making and arguing for a long time, that start looking inward. Now that is just getting endorsed with this budget.
This turn, we upgraded industrials to overweight only in December, about a couple of weeks after the PLI schemes were launched, and that's the turn in stance of the government was starting to become very clear. So it will be pro-growth, but at the same time, we have to be aware that there is a lot of execution that needs to happen, and on the face of it, you see the increases in expenditure are mostly in, road, rail, and water and sanitation. In fact, on other schemes, the quantum of expenditure, while I think like improving primary healthcare, tertiary healthcare in districts and blocks is very important, the quantum of expenditure there is not, as high that it would boost the GDP, which is in the 210 to 20 trillion rupee range. So beyond what has been done on roads and rail, there is not much more that the center can do. We now need to see the state scale up, right? So that now that the center is telling them that, look, you have more fiscal space for the next 2 years, create and we would like you to do capital expenditure. So then can the states come up with projects which are viable and which can be executed, where a lot of the allocations will happen in the next 2 years. So I think there's a lot of execution ahead of us. So I wouldn't try to get overly excited by this, but I think these are very good first steps.
I scanned through your lovely budget analysis. There is very little mention of what if inflation comes back. What if suddenly, if so much of growth is unleashed, could it really have a spiral impact on inflation? You understand the importance of that more than anyone else. How come you're not referring to it aggressively?
See, from a the perspective of inflation, there are, especially in India, I think about two things, and then there is a global perspective which I'll add to that. Remember that underlying inflation, there needs to be wage inflation, right? So you cannot have sticky high inflation unless you have wage inflation. You look at elevated NREGA demand, you look at urban joblessness, right? So one of the criticisms that can be imposed on this budget is that it did not do enough for the urban poor. It did not do enough for the informal sector. And I don't think the government wasn't aware of that. I mean, I think the last 6-7 months, I think the government is acutely aware that these are problem areas. But in the absence of schemes which cannot boost or directly without leakage target some of these problems, its hands were tied. So it is instead relying on overall growth to support that job creation at that level. Now, till we see evidence of that, I think pulling back would be a mistake. So if NREGA demand is so high, if there is such high joblessness in the urban areas, I don't see inflation becoming sticky. The second thing in India is food. Generally, I mean, we can keep debating, and I think we'll keep debating for the next several years as well, that should food inflation really be targeted by monetary policy. But given that we have a surplus of food, and once the supply chains started functioning, food inflation has come down, I don't see that as a really sticky issue. The third is global inflation, and that's something that I think where the both sides of the argument are actually quite strong. My own sense is that the steep increases that we have seen in metals, in oil and plastics, is all, and I mean even in food grains for that matter, is all because of disruptions in supply chains, of the supply chain bullwhip, of in the food grain side, China building safety buffers on food. Once that is sorted out, I don't expect even the commodity inflation on the global level, to actually become sticky. If US fiscal policy moves and they are actually able to get minimum wages to $15 and all of that, that's a very different debate. We have to also remember that in our CPI, global factors play a much smaller role in inflation. So we have to remember that, see, if GDP was 100 in FY20, on a normal path, it would have been 113. And if it was 113 in FY22, no one would have said it's very inflationary. Right now, the government is expecting 102. The IMF is at 102.6. We think it should be more like 106. That is still 7% points less than where the economy would have been, because these are the workers who have been added to the economy. Which is why when people say that, look, we have to get back to the pre-pandemic trajectory of economic growth, that's what they mean. So there is still a 7% gap, even after, if say we see a 4% upgrade to what the government has assumed in GDP numbers. And still we will be 7% below where we were to be. So there is slack in the economy. I don't think just because the government is wanting to spend, inflation will come back. Yes, I think as the economic growth picks up, the momentum picks up, I think it'll be prudent for the government to withdraw the stimulus. But if you look at the nature of spending, most of these are time-bound programs. I think everything is like 3 years, 4 years. A lot of the subsidy numbers already from FY21 and 22 are dropping. The reason I don't talk about inflation is because anyway people are generally worried about it, and I don't think they should be.
Okay. One of the other major steps that was lauded, of course, was the formation of the bad bank, Neelkanth, to absorb secured loans from the books of other lenders, set up along the lines of an ARC, of course, talking about big-time consolidation when it comes to the PSU banking space as well. In terms of course, relief for stressed lenders, that's definitely the aim. Were you looking to hear more details on how this would work or how this would pan out? Are you also very positive on this announcement?
I think it's a step forward, but as many others have said, and so have we, it would have been much better to do it perhaps 2-3 years back. Right now, most of these assets have been written down. So there are two benefits from this, right? The first is that if you transfer it at book value from the PSU banks, it sort of acts as a recapitalization measure. And the second is, of course, that the banks are not really the big experts in resolving bad loans, and therefore this is something that would sort of get them focused back into the lending mode. So the second is now likely to happen, but I must say that the provisioning on this, so these loans have mostly been written down already, so the recapitalization angle doesn't work. But yes, it does free up management bandwidth from going after the bad loans, and perhaps the consolidation of some of these across banks will actually speed up the resolution process as well. As you know, dead weight, dead assets in the economy are a drag on the economy. So once we can get these loans consolidated into one place and get them resolved, I think it will be a step, which was the initial objective, right? When the last 5-6 years, people have been pushing for it. But better late than never. I think it is good that it has been launched. The actual impact on the economy, I'm not overly excited about.
Okay. Also, the clarity with which you outlined the privatization agenda, clearly, of course, continuing to be the focal point, and very aggressively talking about their plans for that going forward as well. While the markets rejoiced it, we have in the past not always seen a follow through. That's the expectation this time around as well, that could we see unions step up, cause a disruption to these plans going forward? Is this again going to be something that gets left by the wayside? Do you feel things will be different this time?
Look, when change of this scale needs to happen, we have to look at the commitment. See, because we are talking about very large organizations, very entrenched interests, right? So the reason these were public sector units, public sector undertakings, was not just the banks, but say even the non-banks, was, there was a whole, decades-long effort. There are people whose, hundreds of thousands of employees who are used to, this was considered almost as good a job as a government job. Now, so there are lots of constituents who need to be kind of taken along with this. And if you just see the change in rhetoric, as I think people like Shekhar Gupta have mentioned, this is the first time that privatization is being talked about, right? That it was earlier called disinvestment, then public assets management, and now the word privatization is being used. I think it just shows the commitment that we are going to stick to it, right? And it has taken, in fact, if you see things like BPCL, the political clearance in terms of the legal change happened in 2016, and here we are 5 years later, it has still not happened. And I don't think it is union problems. That may be part of the issue. But there are other entrenched interests in the government ecosystem which have been resisting these changes. But that does not mean that the government should backtrack. By putting a more strategic sort of intent on top of it, that we have no idea. We will either shut down the PSUs which are not in the strategic sectors, or we will privatize them. I think those statements are very important. So as the new levels of bureaucracy come up to senior levels, I think they'll be much more in tune with this than perhaps the earlier ones were. I don't want to blame the bureaucrats too much, but the point is that the political intent had been there. It has just not been executed. So again, fingers crossed, one hopes that some of these measures that have been announced for FY22 are achieved. But from a pure fiscal perspective, see, it is a lower number than last year, right? And what was budgeted last year. And given how weak are the revenue assumptions, meaning that FY22 or FY20, the assumption of growth is only like 5% a year, CAGR. Whereas the economy itself, I think, would be, I would say 14% higher and maybe 7% CAGR. I think there is a fair bit of slack that has emerged in this. And therefore, I would say that that the potential slippage from the fiscal side should not really be material when it comes to the actual budget numbers, because the revenue side has been, the tax receipt side has been very conservatively targeted.
Neelkanth, so closing comments, let's connect it back for the equity investor. Now, when earnings they come back, they surprise you on the upside. Similarly, when earnings they contract, they disappoint you on the downside. Before the budget also, the rhythm of earning upgrade has started. How will things map now? Are we in for a couple of quarters of earnings upgrade? Because if growth is back, if spending is increasing, earnings have to surprise. That's how history, that's what history has taught us.
Absolutely, and that's exactly what we had highlighted in our CY21 outlook in December last year. That look, the market is ridiculously expensive, but on projected numbers, which I think are too low, and generally when a growth acceleration is on the cards, at some point I think you'll need to worry about inflation, as you asked. But as when the growth acceleration is happening in early stages of that, PE multiples tend to be high. And as I was saying, if you're FY22, when you have an unhinging of forecasts, because it was very hard to project what will really happen when you lock down the economy, and then when you bounce back as well, you don't know how much of scarring is there, what the impact will be. I think it's okay for the forecast to come back to normal. So FY22, look at what IMF did, right? So in 3-4 months, they moved from -2.4 to +2.6. I'm talking about FY22 over 20 real growth. So that's like a 5% upgrade in like 4 months. And can that go to 6? Can there be another 4% growth? Absolutely. I think it should be. And as those changes start to trickle through, and even the impact of the earnings season that we have seen for the December quarter, now for NBFCs also, the asset quality in aggregate is turning out to be better than it was expected or feared, I would say. The earnings upgrades, I think, will continue to happen. And as that happens, then the market should no longer be afraid of being like 3 standard deviations away from average PE on 12-month forward earnings, and be then a lot more optimistic about what may happen over the medium term. As we position for such growth, I think we need to shift our positions, portfolio positions. So all of last year was about, well, almost all of last year, let's say the first 4-5 months of the pandemic, was about which earnings will not fall, and let me give that a higher multiple. Right? So as the domestic savings and foreign flows started to normalize, domestic flows accelerated and foreign flows started to normalize, the sectors preferred were ones where earnings are steady. They did not see much of a cut for FY22 over FY20, and their multiples were taken up. But now, as the earnings for the sectors that lagged last year, like say banks or industrials and other sectors, such sectors, as those earnings are like say four-wheelers, I mean, the earnings normalize. Those are the stocks that perhaps one should prefer and be overweight on, and then go underweight on the stocks which were more about PE and less about earnings. Let's say Indian IT. If they do very well, they'll go from 8% to 11%, right? Or maybe 11, maybe 12. But beyond that, the earnings upgrade will not happen. But the point is, on industrials, on banks, I think the medium-term outlook can actually change meaningfully once the economy takes off.
Neelkanth, thank you for your time this morning. Great speaking with you in depth on some of the major announcements in the budget this time around.
Thank you for having me.